Before the world crashed in 2008, there was one warning sign almost nobody saw, because everyone was too busy believing the same comforting lie. There are moments in economic history when everything appears calm, quiet, predictable. Moments when the numbers rise steadily, when the headlines reassure, when the world seems to be moving forward with a kind of confident momentum. In those moments, danger feels impossible. Cracks feel invisible. Collapse feels unthinkable. And yet, beneath the smooth surface, the pressure is already building. Not loudly, not suddenly, but slowly, silently, relentlessly, until the system holding everything together begins to strain under its own weight. The early 2000s were filled with that kind of silence, a silence built on tidy suburbs, freshly painted homes, wide streets, and the comforting belief that real estate was not just safe, but unshakable. For decades, Americans had been taught to see a house as more than shelter. It was security, stability, the foundation of a future, a symbol of having made it. It was the single asset people believed would never betray them. And it was inside that belief that the seeds of the greatest financial disaster in modern history began to grow. After the dot-com crash, interest rates dropped to historic lows. Borrowing became easier. Refinancing surged. Families who never imagined owning a home suddenly found doors opening for them. Banks encouraged it. Real estate agents encouraged it. Politicians encouraged it. The dream felt achievable for everyone. And in a country built on aspiration, that dream spread like wildfire. But rising homeownership brought rising demand. Rising demand brought rising prices. And rising prices brought something far more powerful, the illusion of certainty. The illusion that housing values could only move in one direction. Upward, steadily, forever. The more prices climbed, the more confident people became. The more confident they became, the more they borrowed. And the more they borrowed, the higher prices went. It was a perfect loop, a self-feeding cycle, until it wasn't. To feed the surge in demand, banks created a new kind of borrower, subprime, people with unstable income, low credit scores, limited savings, or inconsistent employment histories. Borrowers who once would have been rejected were suddenly welcomed with open arms. The reasoning was simple. If home prices never fall, even the riskiest borrower isn't truly risky. If something goes wrong, the house itself will cover the debt. That assumption became the foundation of a trillion-dollar structure. Loan officers were rewarded, not for safety, but for volume. More applications meant more bonuses. More approvals meant more profit. Mortgages were issued with little verification, minimal documentation, and no meaningful risk assessment. Some loans offered extremely low initial payments that would explode years later. Others were approved without confirming income, employment, or financial stability. Borrowers signed deals they barely understood. Lenders reassured them that refinancing later would be easy. The market would keep rising. It always had. But the real engine of the crisis wasn't the borrower or the lender. It was the transformation happening behind the scenes. Mortgages were no longer simple agreements between families and banks. They had become raw material for a far more complex financial machine. Banks bundled thousands of mortgages together, creating mortgage-backed securities. Those bundles were sliced into pieces, reorganized, and sold again as collateralized debt obligations. Layers of risk were stacked on layers of assumptions. And through the magic of financial engineering, something fragile began to look unbreakable. Rating agencies stamped these products with AAA ratings, signaling safety, stability, and strength. Investors believed them. Pension funds believed them. Insurance companies believed them. Foreign governments believed them. Money poured into the American housing market from every direction. The system expanded, the bubble inflated, and the illusion of safety grew stronger. But an illusion is still an illusion. And by 2004, the cracks began to appear. Homes became increasingly unaffordable. Wages remained flat while prices surged. Borrowers accepted loans they couldn't sustain. And when teaser rates expired, monthly payments didn't just rise. They doubled or tripled. Mortgage defaults increased. Foreclosures climbed. Neighborhoods that once symbolized hope now displayed rows of bank-owned signs. The first tremors of collapse vibrated through the system. By 2006, the tide had begun to turn. Home prices stagnated, then dipped, then fell. The foundational belief of the entire market, that real estate values always rise, began to dissolve. And when belief disappears, everything supported by it collapses with astonishing speed. Mortgage-backed securities that once looked solid now revealed their weakness. CDOs rated AAA contained layers of toxic debt. Investors panicked. Banks hesitated. Liquidity evaporated. By 2007, major lenders began to fail. Bear Stearns collapsed. Northern Rock required emergency support. The cracks became fissures. Fissures became fractures. The entire structure began to shake. And then, on September 15, 2008, a moment the world will never forget arrived. Lehman Brothers filed for bankruptcy. A 158-year-old institution, undone not by a single mistake, but by a chain of assumptions collapsing in sequence. Markets convulsed. Global trade slowed. Credit froze. People who had trusted the system found it suddenly unrecognizable. Jobs vanished. Savings evaporated. Families lost their homes not because they made poor choices, but because they had been inserted into a machine they didn't understand. One built on the belief that growth without limit was possible. Governments intervened with unprecedented force. Bailouts were issued. Central banks slashed interest rates. Emergency measures tried to stop the contagion, but the damage was already spreading. Europe was pulled into the crisis. Asia slowed. Developing economies felt reverberations thousands of miles away. The world entered a recession deeper and broader than anything seen in generations. But even as the system unraveled, the most important truth remained hidden beneath the chaos. The crisis didn't start with greed or corruption or ignorance, though all played their part. It started with belief. Belief that markets could defy gravity. Belief that risk could be engineered away. Belief that home prices could rise forever. Belief that the system supporting everything was invincible. And when that belief cracked, the world cracked with it. The aftermath reshaped the global economy. Regulations tightened. Banks were forced to raise capital. Mortgage standards became stricter. Investors learned, briefly, to fear complexity. But the deeper lesson ran far older than the crisis itself. Bubbles don't form because people are irrational. They form because people are human. They want safety. They want stability. They want growth. They want to believe the story that benefits them the most. And they want to believe it long after the warning signs appear. The 2008 housing bubble wasn't just a financial event. It was a psychological one. A moment when optimism turned into overconfidence, when overconfidence turned into fragility, and when fragility finally collapsed under its own weight. And though the world rebuilt itself afterward, the rhythm that led to the crisis never truly disappeared, because financial systems change, regulations change, markets evolve, but human nature, for better or worse, remains constant. And somewhere, quietly, the early foundations of the next bubble begin forming long before anyone recognizes the pattern. The story of 2008 is not just a warning, it is a reminder that value is fragile, belief is powerful, and every bubble, no matter how large or well hidden, begins the same way, with confidence rising, and ends the same way, with confidence collapsing. The world didn't break because the housing market failed. The world broke because the story supporting it finally lost its magic. And somewhere in the quiet spaces of today's economy, a new story is already being written.